Welcome to this Killik Explains finance video. This week, why investors should turn off their screens when markets fall, or the dangers, literal and metaphorical, of seeing red. Now, controversial theory coming up, but actually a very interesting one, so let's take a look at it. So the problem is this: we are programmed to react strongly to financial information displayed in red. This is not just my opinion, a reference to a paper coming up in just one moment. Typically, as you'll know, this is how falling prices are displayed, whether you're looking at Reuters or Bloomberg or an app screen, for example. So good news tends to be, let's say, green or blue. It isn't red. Red is reserved for bad news. And what it does, according to the authors of the paper I'm about to mention, is trigger a fight or flight, I'm using red myself, response. It's the flight response that can be dangerous. Because, as a consequence, when we see red, all right, and if we're bombarded with red information in particular, we tend to overtrade our portfolios. We tend to market miss time. We tend to get stressed. So in other words, we bail out the market. And then the authors are saying just seeing data in red may not only alter our risk attitude and our future expectations of returns from stocks, for example, but also our propensity to invest. So it may actually defer us getting back into the market. And there'll be a stat at the end of this presentation that illustrates how dangerous that can be potentially. So interesting stuff. In other words, in trying to explain why sometimes retail investors, private investors, don't make as much money over the long term as they should, the authors are saying that literally seeing red is bad news. Who says this? Well, we've got three authors this time. It's a Swedish House of Finance paper, and at the end, do feel free to ping me if you'd like a link to it. So it's the effects of colour on investment behaviour, and it's relatively recent, 2017. So let's take a very quick look at the main premise of the paper. Now, why do we react to red? Well, the authors are saying basically there are biological origins. So as humans, we're programmed to, and then there's a kind of cultural overlay, which is stronger in some cultures, like here in the UK, for example, than it is in others. In fact, in other cultures, like in China, it's the reverse. Red is seen as a positive, strong colour. But let's come back to that in a moment. So biological origins. Red is the colour of dangers like blood and fire, for example. It appears to stimulate a biological avoidance reaction. I'll give you a paper reference to that in just a moment. And studies done on particular types of monkeys, for example, have shown that they are less likely to steal, in one study, from someone wearing red. So in an attempt to sort of give a control to some of this data, the authors have come up with papers that seem to demonstrate that red actually matters in terms of the way that we behave and in terms of the way that other animals behave too. Now the cultural reinforcement on top is, and this doesn't really need me to tell you, it's teaching you to suck eggs in a way, but you'll know that red is the colour we use to suggest an error or a correction, ringing stuff in red when it's wrong, for example, at school. Alarms and stop signals, anyone who's seen a traffic light will know what I'm talking about there, tend to be in red. And our language uses red, in investment terms especially, to demonstrate a problem, danger, risk. So red flags, red herrings, in the red, and so on. Not true everywhere. So as I say, in China, for example, this cultural reinforcement is much, much weaker if it exists at all, but here it's pretty strong. So layer cultural reinforcement on top of those strong biological origins, and the authors are saying that seeing red literally can be a problem. So, big debate. So rational economics, so economic man, if you like, on the left-hand side would say this is nonsense. Basically, we make investment decisions purely rationally, says the economic textbook, if you like, and that's why Richard Thaler, presidential address to the American Economic Association in 2016, talked about supposedly irrelevant factors, including colour and the colour red. As a rational investor, that shouldn't make any difference. It shouldn't make any difference if we see a price in red, green, blue, black, or any other colour. But biologists and psychologists beg to differ. They say, and there's an example of each here, that colour is important. In other words, there are reactions that go on in the brain and our neural pathways that matter when we see red. And psychologists have shown, or tried to show, that the physical and psychological context in which colour is perceived influences its meaning and human responses to it. That was Elliott and Meyer back in 2012. So there are several papers referenced within this broader paper. In other words, economists would say colour completely irrelevant to a rational investor. Biologists and psychologists say, well, I haven't met one, and actually colour really does matter, particularly where you've got that biological and cultural overlay sort of combined. Now, what does it do to us then? So what does seeing red, according to the authors of the wider paper I mentioned, the Swedish House of Finance paper, do to us as investors? Well, here are some stats. So the Swedish House researchers reckon that investors take approximately 25% less risk when shown potential losses in red. So just being shown data in red changes the way we perceive it. if you like. And our, to use technical data, our risk premium immediately rises. Viewing past returns in red leads us to assume that they will continue. If you think about that, it's completely irrational. I mean, basically, if prices fall yesterday, they could then rise, stay the same, or fall the next day. There's nothing to say they need to go in one direction or the other necessarily, but the very fact they're shown in red, those price falls, makes us more likely to assume that the next set of results will also be bad news. So that's quite interesting. All right, so that's where we're most likely to hit the panic button, if you like, and sell out. But then it's worse than that, if you like, because the authors have said we find that the colour red reduces investors' propensity to purchase stocks by about 20%. So not only will we kind of panic sell out of stocks potentially on the left here or stay away from stocks, but actually we're not going to buy back in, having done that, according to the same authors. It systematically reduces an individual's expectations around future stock returns. In other words, having got out of the market, we may spend far too long on the sidelines, simply as a result of seeing red in the first place. Now, the implications are quite significant. I mean, what are we going to do about this? Basically, firms designing, for example, apps for customers got to be a little bit careful, because actually, if the colour red does create counterproductive behaviour that's going to damage long-term returns, then maybe firms need to think about the frequency with which stock data is displayed and how it's displayed. And for investors, knowledge is power, if you like, so just knowing what I've said about the colour red is to some extent useful, but basically make sure that you are not inclined to panic, sell up and delay buying more often than you should. So in other words, don't turn on the TV when markets are crumbling, don't look at an app too often, don't check your investment performance too often, close the newspaper, because all those red headlines, according to the authors, Swedish House of Finance, could be actually triggering counterproductive reactions. So switch off your TV, switch off the app, and regulators need to bear this point in mind at the bottom. Just receiving information more frequently doesn't, of course, make it better information. And I would say when markets are volatile, receiving information in a way less frequently is arguably better. Now, just to wrap up, a statistic. So why might those percentages that I talked about just now from Swedish House of Finance hold true? Well, here's the risk of seeing red. JP Morgan, and they're not alone by the way, did a study on the S&P 500, massive American index, 1993 all the way through to 2013. And what they found was this: anyone who missed just the 10 best investing days, which, and this is key, followed some of the worst, could have halved their annualized returns. That's a massive difference from just missing 10 days. So why is that happening? Could it be that the screens go red, people push the panic, get me out, phone their brokers, get me out of these stocks, all right? They then miss the bounce that follows because they're sitting on the sidelines in cash, and some of those bounces are sharpest right after a dip, and I've done videos on why that is separately to this one, and that is what is happening. So people are basically really hitting their long-term returns from a broad index like the S&P 500 from the American stock market by simply missing out on a few investing days. And could it be that seeing the colour red is behind some of that? Controversial topic. So if you want to see the full paper and you can't find it, do ping me an email, editor@killik.com. And to watch more videos around the kind of behavioural psychology side of investing, do go to killik.com/learn.